Welcome to Pro News Weekly. Let's check out the latest financial market news. U.S. stocks are falling and dragging the dollar down with them. Gold is recovering losses, and Bitcoin is rewriting a record high. Trouble is piling up for the U.S. After trade wars, fiscal issues are now weighing on the dollar. Moody's became the latest major agency to strip the U.S. of its highest credit rating. Republicans were divided over the massive tax cut bill that Donald Trump is counting on. Finally, a weak 20-year Treasury bond auction gave rise to concerns about cooling demand for treasuries from foreign investors. As a result, the rush to sell American assets flared up with renewed vigor, and one of the main casualties was the U.S. dollar. The White House's policies have shaken confidence, while rumors of coordinated currency intervention following the G7 summit in Canada are fueling the imagination of USD bears. Add in growing fiscal concerns, and the dollar's decline comes as little surprise. The euro and Japanese yen are typically the main beneficiaries of coordinated currency interventions, such as the 1985 Plaza Accord. Given their significant weight in the US dollar index, any renewed intervention efforts would likely push the dollar back into a downtrend. Throughout most of May, the S&P 500 rallied on the perception that the US trade war with China had been resolved. The swift truce and de-escalation in rhetoric boosted risk appetite. The broad stock index appeared unfazed by signs of a cooling U.S. economy, the Federal Reserve's reluctance to cut interest rates, or the downgrade of the United States' credit rating. This could not continue indefinitely. U.S. equity markets are hopelessly losing out on European equity markets and technology companies to their cheaper Chinese counterparts. Capital flows from North America to Europe and Asia risk accelerating, depriving the S&P 500 of important support. The trigger for the reversal in the broad stock index was a failed Treasury auction, which pushed U.S. yields higher. Previously, yields had been rising on optimism that recession risks were fading. Now the increase reflects concerns over accelerating inflation, mounting government debt, and the Treasury's growing difficulty in financing it, especially as foreign investors withdraw from the market. This creates a serious headwind for the S&P 500 and increases the likelihood of a continued stock market peak. The erosion of confidence in the dollar due to Donald Trump's tariff policies and in treasuries due to fiscal concerns has made gold just about the only safe haven asset. The precious metal is actively taking advantage of this, having risen from the ashes after the de-escalation of the U.S.-China trade conflict. Moreover, Russia does not intend to stop the war, and American intelligence reports that Israel intends to strike Iran's nuclear facilities. Rising geopolitical risks are forcing investors to channel money into safe havens. Demand from central banks in China remains strong. The Middle Kingdom imported 127.5 tons of gold in April, an 11-month high. The indicator increased by 73% compared to the previous month, even as the precious metal soared to record highs above $3,500 per ounce. The stagflationary scenario in the U.S. also supports gold. Tariffs and fiscal stimulus will accelerate inflation, while high rates of the Fed and the U.S. debt market will continue to cool the economy. In such a situation, gold feels like a fish in water and will at least maintain a tendency to consolidate in the range of $3,100 to $3,400 per ounce. Bitcoin hit a new record high on the back of progress in advancing stablecoin legislation. Capital inflows into 12 U.S. ETFs of around $4.2 billion in May. Purchases by the token accumulator strategy of over $50 billion, and U.S. fiscal concerns. Unlike previous rallies, the current upward movement is not solely driven by momentum. It is based on increased demand and White House loyalty. The Democrats have dropped their opposition, and the Senate will soon consider the stablecoin legislation. It would place tighter restrictions on money laundering, improve consumer protections, and unify business rules for U.S. and foreign companies. The chances of the cryptocurrency bill being approved by Congress are seen as higher than those of Donald Trump and the Republicans' tax cut initiative. Fiscal concerns are weakening the dollar and pushing up Treasury bond yields. According to Galaxy Digital, it is becoming increasingly dangerous to invest in a country with such huge debts. Investors are looking for alternatives and are finding them in Bitcoin. Not surprisingly, the paths of BTC-USD and the S&P 500 have diverged. Investors' focus in the last week of spring will be on U.S. fiscal problems, trade negotiations with other countries, and rumors of coordinated currency intervention after the summit of finance ministers and central bank heads of the G7 countries in Canada. The slightest hints of forex intervention are fraught with serious fluctuations of dollar pairs. The main event of the economic calendar will be the publication of the minutes of the last FOMC meeting. Investors will be looking for clues about the fate of the federal funds rate, although it is highly doubtful that the Fed will lower it before September. personal consumption expenditure index data for April, the second estimate of U.S. GDP for the first quarter, and German inflation statistics are likely to rock financial markets. Still, they are unlikely to change existing narratives and trends. Follow Pro News Weekly for more updates on global markets. Like, share, and subscribe.